Hmm. Oh, is it time to do another Q&A video? Answering your questions that have been submitted through my Facebook channel, the YouTube channel here, other questions that I found on the internet. I found a couple websites that offer questions like Yahoo Answers and Quora and some of these other places that have really good questions about real estate world. And you can see kind of trends as you look at some of these websites. You'll see kind of a common question start to pop up. So I find it really useful to go to these sites to answer some of the real estate and mortgage questions. So let's jump into a couple here real quick, see how many we can get to. I try to keep these videos to about 20 minutes or less, and I'll post the timestamp so you can see what questions that we answer during the video. So the first one here, what are the benefits and drawbacks of taking out a mortgage or home equity loan when refinancing your home? So these are two very different loans. So they're going to have very different terms, underwriting guidelines. They're going to have different benefits and disadvantages based on your needs. Typically a mortgage, like the mortgage used to buy the home, if you do a cash out refi, you have to refinance your first mortgage. So if you've got a rate that's really low and now you're refinancing to a higher rate, you just have to make sure that the money you're pulling out can offset your debts, maybe pay off some other bills or improve the home, improve the value. So it kind of depends on where the money's going to determine if it's worth raising the rate on your first mortgage. Now, obviously, if the rate is lower than what you have on your first mortgage, it's kind of a no-brainer. Is to just not only are you lowering the rate, but you're also pulling the money out. Home equity lines of credit have gotten really popular because most people have a really low rate on their first. They've got all this extra equity, so they can just tap into a small chunk of it, maybe 50,000, 100,000, just kind of a small block versus what the home is actually worth. The downside with home equity lines of credit, they're typically adjustable rate mortgages. But you're only paying interest on what you actually borrow. So let's say you get a $50,000 line of credit, but you only need 10 grand to pay off debts or do home improvements, recarpet, whatever it is. You're only paying interest on the amount you actually draw. Plus, as you pay that down, if some other expense comes up and you paid it down, you can use it again, very much like a Visa. Really, home equity lines of credit are really like credit cards tied to the home. So they'll give you better rates than any other type of line of credit, but they're still higher than the rates available on a fixed rate mortgage if you refinance the first. So again, they all kind of have little needs they're trying to fit. They all have benefits and disadvantages based on what you're using the money for, how long you plan on keeping the home. These are some of the factors that I sit down and talk with my clients on to help them decide which one is better. But lines of credit or HELOCs, home equity lines of credit have gotten really popular because the rate on the first is so low, they don't want to touch it. But they have all this equity. They want to get to it to do whatever else, add a pool or home improvements or pay off a bunch of other debt. It makes a lot of sense if you use the money correctly. That's the biggest tip I can give you. Where is the money going should help determine what loan you get and how long you plan on actually keeping the home. Okay, here's a question. How possible is it to pay off a loan within 5 years? Pay extra. That's really what it is. You get an amortization schedule. You can go online and get calculators, but you can figure out how much it is. But I tell you, going from a 30-year fixed mortgage to a 5-year loan is going to be a massive increase in the payment. I'm not talking double. We're talking triple. We're talking a lot more. So usually what you'll see people do is maybe get bonuses or they sell another property, and that's what they use to kind of pay down the home. But honestly, I'm a big advocate that that's the last thing that should be paid down. The rates are better. They're locked in. They're fixed rate expenses. Sure, your taxes and insurance might change a little bit, but nothing close to a fixed rate mortgage as far as debt servicing cash flow is a mortgage loan versus any other type of debt out there. So if you have any other debt, pay that off first, because an extra $100 on a car loan, an extra $1,000 on debt will go way further than any mortgage. And the mortgage is already a locked fixed expense. So I would start with everything else, then start rolling that money into the mortgage. And the reason why I say that too is once you pay off the home or you pay it down, you can't get that money back without selling or refinancing. So if you got all this other debt all over the place, but you have the house free and clear, this debt goes away quicker. Also, I would say add to savings. If you're adding $1,000 to the mortgage, 1,000 to savings, you can get to easier. It can increase in its value as well over time. You'll have more money kind of sitting over here than a bunch of equity you can't get to. So I think the mortgage is definitely something you want to try to accelerate, maybe round up the payment a little bit because there is still interest involved. But I honestly tell my clients, wait a minute, you've got $1,000 worth of other payments over here. Get rid of those first. Pay those down. Money goes further over here than putting it towards the same mortgage, especially if you need that money back. or really, really increase your savings. If you've got $1 million in the bank and $1 million in equity, which would you rather have at the end of the day? I'd rather have the money. I'd rather have access to that, to be able to not have to borrow for a car or other expenses, or if the transmission of the car just falls out, or I need a new car, or medical stuff pops up. Having the money in the bank is way better than equity you can't get to. So I'm a big believer in paying the mortgage off last. All right, what else we got here? Let's see. Why is an interest rate on a cash out refi usually lower than the rate on the original mortgage? There's a couple things here. So cash out refis will always be a higher rate. So today, if I look at a rate sheet and say the rate's 7%, the cash out refi is always going to be higher. Now, maybe the rate when they did the loan was 7 and now rates are 6 or something, so they've lowered, but a cash out refi will never be a lower rate than a purchase mortgage. Now, why is that? Because you're upping the loan amount, you're typically adding cash that you're taking out of the property, and there's more chance of default when people raise their payment or change what they're doing or pull out cash. Also, it's changing the loan to value, like what the home is worth versus what's owed gets increased, so there's risk there. So just cash out refis will always have a higher rate. But most people will refinance. One of the reasons to refinance is to lower their rate and to maybe get some cash back. So it's really based on what the rate that they first got to the rates available today may be lower. Hopefully it is. That's the reason to refi is rates are lower. But never on a single day are you going to see someone on today's rate sheet, for instance, here's the purchase money rate, cash out's always going to be higher. That's always going to happen. Cash out refis are always going to be higher. Now, it might be lower than the original note rate because they've refinanced, but it's day to day. Like each day, you're not going to see a cash out refi be cheaper than a purchase money loan. All right. Here's a very common question. I got this one probably the most in the last maybe 30 days. I don't know what's kicking up out there, but divorces. So if you have a mortgage and it's you and your spouse and you're both on the loan, and you go to get a divorce, typically something has to happen with the real estate. Either someone's awarded the home, or they're awarded half the equity, or they're commanded to either sell it or refinance the person off. So just because you have a divorce and the judge has signed it doesn't mean the note holder, the mortgage company, says, okay, you're off the hook for the loan. The reason you got the loan in most cases is both of you had to be on it, or both of you were on it for estate reasons like estate planning or something where you both were on the loan when you signed the note. The note was signed years ago. Whenever you did your mortgage, the divorce is now. It doesn't supersede or go back and say, okay, now the spouse is off the hook for the loan. They're still on the loan. It's still on their credit report. The only way to get it off is either sell the property and everybody walks away from the house and splits the equity, or one of the spouses needs to requalify for the home. What I see happen a lot is the wives usually get awarded the homes. The kids stay in the home. They want to keep the kids in the school districts, whatever it is. So a lot of times you'll see the spouse actually gets awarded the home, even though they can't qualify for a new loan. That's where it gets sticky. That's where you typically will see somebody be on that loan even well after the divorce. But there isn't anything. I have seen court orders where they get removed. That gets really sticky because the courts don't want to superimpose on a mortgage company to remove somebody off a loan if that's what was used to qualify. I have seen times where the lender will work with them if they can qualify and they can do a refinance kind of in-house. But generally speaking, a new refinance would have to be taken to take one of the spouses off the loan, off the debt, off the history, so to speak. So that way, if the spouse starts missing the payment, it doesn't affect the other person's credit. I tell you, there's probably nothing outside of a bankruptcy. Divorce is probably one of the worst things that happens to credit because so much of your credit is intertwined, co-signed and intertwined. So when you try to pull that away, people will miss payments on the car or won't have the income to actually cover everything, or they don't pay the child support or the alimony, and disputes happen. And just, I tell you, credit gets just trashed after divorces. In fact, a lot of divorces actually lead into some form of bankruptcy. But this is one of those things where, just look at it this way, the mortgage was signed years ago, the divorce is today. This still supersedes anything that happens with the divorce. And that's where typically it either needs to be sold or it needs to be refinanced if the spouse can qualify. And that's where you usually run into the biggest problem. They just can't qualify for the loan. And you're seeing now where people have these 3 and 4% rates, would have to refinance into the high 6s. They're also like, ouch, now my payment goes dramatically up, or just keeping the existing mortgage I have. So it is a sticky situation. Divorces just suck. They really do. All right. How are we doing on time? Oh, man, we're cooking with gas here. Okay. Next question. Why is it easier to get a new mortgage than a refinance. I'm assuming that means like a purchase or a new home purchase loan versus a refinance. Honestly, I would say it's not. They both have guidelines that have to be followed. If you can't follow the guidelines, if it's hard to get the guidelines for the purchase, the refi is not going to be much easier. But honestly, I would say refis probably are a little bit easier because you're already in the home. It's just paying off the debt that's on the home. You don't have to put in a new down payment typically because now you can use the equity of the home since you've been in the home. But they have very similar guidelines. Where they differ is where you usually may run into issues. But I wouldn't say a purchase is easier than a refi or refi easier than a purchase. Maybe a refi slightly easier, but it's not. It's still a mortgage. It's still loaning hundreds of thousands of dollars. It's still verifying income, verifying credit. What's the money being used for? What's the occupancy? They're guidelines for both loan programs. And they're not making it easier or harder on one. That's the guidelines based on the type of loan that you're trying to get. So I really wouldn't say they're dramatically different. They really aren't. They're still qualifying. I would say this as well. It's not easier to refinance with your current lender. So if you have Mr. Cooper or Nation Star or all the other ones out there, Wells Fargo, Chase, whatever you have, most likely that loan was packaged up with other loans and sold to different servicers. So in many cases, refinancing with your current lender really isn't going to be any different because guidelines can change. They still got to verify income and assets. There's still federal requirements they have to follow, regardless if you're already a client. They might make a few things a little bit easier, but they're not just going to waive pay stubs, W-2s, pulling credit, appraisal. These things don't get waived typically because when you think about it, a lot of times a loan got sold and purchased by that lender, they still have to update everything to do a refinance. So I know they'll offer incentives. You'll see stuff in your mailing. They'll mail you your statement or on the website when you're logging in to make your payment. They'll have all kinds of little specials to try to retain you as a client. But a lot of times it's not easier to refinance with your current lender. Talk with me, talk with other lenders, shop it around a little bit. You might find better rates and terms than even the lender that's servicing your loan. All right, here we go. Now this question, this comes up more than I would think it would. And I'm not sure if it's just because it's a home and it's a mortgage and just the terminology of it. But this does pop up a lot on Yahoo Answers, Quora. I've even had a couple people post on my YouTube channel. What are the consequences of not paying off a home before selling it? So if I was telling you I'm selling you my car and I owe 10 grand on it and I'm selling it for 20, do I have to pay off the 10 grand before I can sell it? No, on a car you could owe, as long as you're selling it for more than what you owe, whatever's left over you would keep. It's the same with the home loan. Now, maybe the car loan's a bad analogy because a lot of times you have to roll maybe negative equity into the next car and stuff like that. But it's the same concept. If you owe on a home, you don't have to have it paid off to sell it. Whatever you sell it for, that will go to pay off the loan, pay commissions, pay title fees, home inspection, whatever fees, whatever's left over after all that, that's what you get to keep. So you would get a check from the title company or a wire from the title company that would pay you the difference after everything's balanced. So you don't have to have the house paid off. I see this question a lot. I'm not sure why that would be different for a mortgage versus any other asset that you're selling if you have a loan against it. So if you have a piece of art that you've got a loan on or something, or if you got a car, a motorcycle, a four-wheeler, almost anything, if there's some loan tied to it, you just have to sell it more than what you owe. And then that gets paid off. That lien gets released. The new lien gets put in its place and everybody moves on. It happens. I don't know how many times today that's going to happen, around the country. Very, very common. Most people don't have their house free and clear when they sell it. I'd say a huge percentage of people don't have their home free and clear when they sell it. So it is something where it just gets paid off with the proceeds of the new loan that's replacing it. Or if the person's paying cash, it pays off that loan. Whatever's left over is what you get to retain. Now, that percentage of what you get can have capital gains depending on the use of the property. So you want to check on if there's additional fees after you net whatever you net. But it doesn't, short answer to this question, it does not have to be free and clear to sell a home. It doesn't. All right, let's see. Here's a quick one. How does a lender release a mortgage lien? There's a form here in Utah, in many states, it's called a reconveyance. So once the balance is covered, the title company coordinates this. That's why there's title insurance involved to be able to kind of handle the delay from the second that lien gets released before they get their money. We get written payoffs. There's a lot of processes to make sure that the mortgage company gets their money to release that lien. If it doesn't get released or doesn't get the balance paid in full or something happens, that's where title insurance usually kicks in to cover whatever was a mistake. Very rarely is there any mistakes with that, but stuff does happen. That's why there's an insurance to protect you as the owner, the lender, everybody involved, to make sure everything does get released, everything gets paid off. But the form that actually gets signed, and sometimes it can be later on, not right the day you get the house, because the title company can show all the evidence. They got everything. They wired the money. They can show all the proof that that lien should be gone. If a question ever pops up years down the road or something says, hey, there's still this lien on this property, or they go to sell it or something. So that's what that title insurance is designed to do, is kind of bridge the gap between when the paperwork actually gets signed. But the form is called a reconveyance. It releases that lien against the property, whether it's a first, second, third, whatever position it's on, typically called a reconveyance. Let's check our time. Ooh, baby. Yeah. Let's see. Let's go to some new ones here. These are some of the ones that I answered. So I just like to kind of have that as a quick summary. Let me check. Let's see. When you refinance, how does the mortgage holder get paid? So it's that same thing. So when you refinance, that new loan's replacing the old one, and part of why you have a title company involved is to make sure that that transaction happens correctly. So we'll get a written payoff from the existing lender saying, okay, you owe $250,000, you're doing a loan for $300,000, the fees, the balance, that gets taken off, the rest goes back to the client. So the refinance, just like you would on a car loan. If you're refinancing your car loan, now I would say a lot of times with car loans, you might see where it's refinanced with the same credit union or bank. You're usually not switching lenders in that case like you would maybe with a mortgage, but it's the same concept. The new loan amount has to be enough to cover the old one to where it gets done. And then the title company kind of handles the logistics of how those liens get released and new liens get put on. So literally there is a second there where the property is free and clear for like literally a second from when this lien is released and this one's put on there. But that's why a title company offers the lender's insurance to make sure this new lien does get put in there and this old one gets removed. So very simply, the refinance just has to be more than the balance on the home, plus any fees involved. You got escrow accounts, appraisals, underwriting processing, maybe points. Those types of things also have to be factored into a refinance. Let's see. Oh, should I pay extra to my mortgage every month? Again, yes, I think rounding it up is great. I think paying a little extra is great, but I always want to say, okay, you've got your $1,000 mortgage, your $1,500 mortgage, maybe your $5,000 mortgage, whatever you got. If you have other debt, you want to pay that down first. So here's how I do. Let's break it down. You want to have money in the bank first. You want to have emergency funds, savings. You don't want to have to borrow against a credit card to make a payment if you lose your job or have to take some time off or get injured or the kids get sick. Life's going to happen. So having some money in the bank to just reserve to kind of get through that is crucial. The rule of thumb is 6 months worth of expenses, especially mortgage, 6 months worth of mortgage and car payments. You want to be able to do that. You can cut other things. There's a lot of things you can cut out, maybe subscriptions, you can cut out certain things, but car and transportation to get to work, get the kids to school, whatever, and mortgage, home where you're living really should be an emergency fund first. So before you start paying extra to anything, make sure you got the reserve set up first. Then start paying the other debts. I always recommend going with the lower ones and kind of snowballing it up, because I think math is not just about math. It's about momentum. It's about being able to say, okay, that debt's gone. Now take that payment, roll it to the next one. Now I'm putting 100 extra to that card. Then I'm putting 200 extra and just roll it up to the next ones. You also want to look at what interest rates you're paying. Obviously, if you have a higher interest rate credit card, you do want to tackle that first. But if that's 10 grand and you got one down here at 2,000, there's something about paying this one off and getting the reward, getting the victory, getting the sense that, hey, I'm getting somewhere, that debt's now gone and I can close it, and rolling it up to the other one. Too many times I see people try to tackle the $10,000 card where they have all these other small ones. It doesn't seem to get anywhere. They're 6 months into it. Nothing's paid off yet. They just lose it. They just don't stay momentum. They don't kind of keep things going and get rewarded and go, hey, this is actually working. I'm getting this stuff paid off. So I really recommend the smaller debts first, or the ones that have the highest rate that are also the smallest, so you get that momentum to where you can roll the payments into the next one. But extra to the mortgage, $50 extra to a mortgage, $100 extra to a mortgage is great, but 50 or $100 extra to a car or a credit card, or same as cash, whatever's out there, PayPal, Synchrony, whatever it is, you're going to get so much further with that money going there. But start with savings. Get to the point where you don't need the credit card to pay for an expense, that you've actually got the money in savings, and truly separate it from your day-to-day. This is something I recommend to all my clients. Society is designed to take your money. The commercials, the lifestyle, every commercial's got the perfect lighting and music and soundtrack and people happy and smiling about eating their hamburger, whatever the advertisement's for. Your willpower will not be better than their psychology. I'm telling you right now, listen to me. Their psychology will be better than your willpower. I guarantee it. So you have to work your system. Take your savings and have it separate from your day-to-day checking and savings, whether that's an online account or somewhere else where you can put it, or a separate bank where you don't have access to it day-to-day. You're not seeing that money there. You want to take that separation. You want to separate yourself as best you can. That's where I would say is the most important step. Then start paying off debts. Then start maybe looking at tackling the mortgage. But I'm a big believer that there's other places that money goes that goes way more effective than towards the mortgage. Boy, there was a soapbox for you. Ooh, and we just hit the 20-minute mark. So guess what? We are out of time. I hope you enjoyed the show. Comment, post, subscribe. Let me know what we're doing right, what we're doing wrong. I really enjoy doing these videos. You see, I've done a lot on my channel here. I have a lot of fun talking about this stuff. I get talking too quick and too excited, but that's just what I like doing. I've been doing home loans for a long time. I love helping people with debt management, real estate investing. This is fun stuff. It really is. And I love the opportunity to help and share my expertise and my passion for what I do for a living. So if you are looking to buy a home, refinance, home equity line of credit, bridge loan, anything with real estate, I lend in Utah and Nevada. Our company lends almost every state, so I can help you just about everywhere, but I focus on Utah and Nevada. But love the opportunity to work with you. Check out my website, ryanbolton.com, and we'll see you next time on the next video. Have a wonderful day.